I'm going to be talking to Ed Hurst, the energy economist from the University of Houston, who often comes on and explains global and American oil and gas stories for us. We're going to be talking about OPEC Plus and its role in the markets. What's OPEC doing, and what we might be able to, we'll likely see over the next 3 months to a year. So, welcome to the interview, Ed.
Thank you, Markham.
This is interesting. So OPEC for a long time was cutting production to support prices. American shale was rising. Canadian production was rising, and now it's reversed its course as of April, and it's begun adding some of that supply that was cut back into the market. So what's the Saudi strategy here?
There are probably three things going on here. First of all, oil was in the 80s when President Trump took office, and the first thing he called for was lower oil prices. And that was his first trip overseas. There were some trades, some mutual investments, but the key thing he wanted were lower oil prices, not just for the American consumer, but also to put some constraints on Russia and certainly on Iran too. The Russian oil exports have been funding the Russian war machine. They've been buying an awful lot of military equipment, including drones, from Iran. Having these two adversaries to the Western world, being funded essentially by the allies who are buying the oil, that's a problem. Trump has very recently, of course, was addressed the UN, complained loudly about the Western nations and China buying from Russia and funding that. And we all know the Iranian oil is getting to market somehow. We all know the Russian oil is going to get to market. The charts that we saw yesterday that were widely published showed that there's a huge amount of oil in storage on the seas. And there's a big effort to try and rein in these tankers and the dark fleet. There's a lot going on here, but what we're seeing is OPEC pushing to gain some market share, those three vectors, if you will, come together in OPEC's favor right now, to the detriment of, say, the oil producers in the U.S.
Now, there's been a lot of talk about why prices have stayed as high as they are. I mean, they're in the low to mid 60s. And yeah, so the argument is China's been buying for its reserves. The US is also adding to its reserves. You've got the enormous amount of oil that's actually at sea, which is kind of like a storage capacity. And you've got a weakening global economy, which always weighs heavily on oil demand and prices. And on top of all of that, as if that wasn't enough, you've got China's oil demand seems to have peaked this year and will more than likely, and that's after 20 years of growth. So China is no longer a growth story. It's a plateau story for the next foreseeable future. I guess if you add all of that up, that has to, at some point, weigh on oil prices.
It will eventually. Keep in mind that the oil that's traded in Rotterdam, that's traded on the NYMEX, WTI, this represents a very small fraction of the global oil market. In fact, if we add up all of the contracts that are outstanding, it might amount to as much as 6 months of global usage when we're looking out decades. So little bits of movement make a big difference. And the price of oil is, as we know, very price inelastic. All of those tankers won't land at once. Their storage at sea, the expectation is that the prices will begin to fall pretty significantly before the end of the year.
So let's talk about OPEC's strategy here, because OPEC is essentially the swing producers in the global market. They can add or subtract supply to maintain prices in a range. But we've wondered for a long time if at some point the OPEC producers, particularly Saudi Arabia, would begin to put oil back into the market to take more market share back in the face of potentially peak oil demand and then decline. So if that's if demand declines, the resource becomes less valuable. You may as well maximize it while you have the chance. That's the logic. Are we seeing the first glimmers of that strategy come on, playing out?
Well, it's certainly possible. And as we pointed out, China has plateaued for now. Uh, electric vehicles are going in across China like gangbusters. They certainly are going in across the EU. They've had tremendous growth in the US. Every one of those that gets produced and put into operation means one less gallon of gasoline a day, if you will. Eventually, that's going to add up over time. The Saudis have a very cheap resource. Most of the OPEC nations do. I'm sure they're concerned about a stranded asset sort of issue, but right now, I think the primary drivers are Trump's request for lower prices, the strategic issues with Russia and Iran in particular. Market share at the expense of the U.S. shale patch, certainly that works. You know, to the extent that they can drive down oil prices and delay a consumer's purchase of an EV, maybe that's at play. Certainly it will be, if not this year, then next year or the year after.
So just to sum up, Ed, we've basically got this very complex market situation, and it's very fluid. It could go one way or the other, not entirely sure. And we're not, maybe we're seeing the beginning of an OPEC strategy to deal with a declining resource. Maybe we're not. Maybe that won't happen for a number of years in advance. But clearly, volatility is going to be the characteristic of the market going forward over the next year or two. Is that a fair summary?
Absolutely. Well, but I expect it to be pointed down. The Trump administration, Trump 1.0 had much lower oil prices, even if we just take out the pandemic slowdown. That's what he wants for this one. He's working agreements back and forth with the OPEC nations. I expect that they're going to do what they can to accommodate him. And again, think of the strategic issues. It's not just the West against Russia and Iran. The Saudis and Iran have been at loggerheads forever. Anything that can work to defang the war machines of Iran and Russia are in the interest of the world, I think, overall.
Let's close the interview with a little survey on what's going on in the United States. What's the take on this? Because, during the election campaign last fall, it was drill, baby, drill, and the oil and gas industry was foursquare behind President Trump. And now that he's calling for lower oil prices and, they're starting to take drilling rigs out of the patch and so on. And you're based in Houston, so I'm sure you have your ear to the ground. What's the sense, how are people feeling about President Trump?
I don't have to keep my ear to the ground. This is out in the open. Exxon's laying off thousands of workers worldwide. Chevron has laid off thousands. ConocoPhillips, which is now an independent, laid off 25% of its workforce. The cuts are coming fast and furious. The oil field service companies began their cuts essentially as soon as Trump took office. The costs have gone up, the revenue has gone down, and if you're going to survive in the oil patch, you're going to have to batten down the hatches. This is now October. The borrowing base redeterminations should now all be complete, and we should be seeing the independent oil companies, those that have borrowed anything from the bank, readjust their production targets, readjust their spending. And I think that's going to point down for the rest of the year.
Ed, as always, thank you very much for this.
Thank you, Mark.